Hello, hello.
Hey,
Hello, hello.
how are you?
Hi, Jedi.
Fantastic.
Finally get to speak to Dimitar. I've listened to you speak so often around so many different things around IPOR, and now I get to actually speak to you directly. I'm actually looking forward to it.
I have to say that I'm a little bit intimidated by your voice, mate.
Better than mine, so you got nothing
it's,
to be intimidated by. So,
it's a very deep, deep voice.
Dimitar, what nationality are you, if I may ask?
I'm Bulgarian.
Bulgarian. I actually thought you might have been possibly Greek.
No. Greeks do not have such strong Russian accent when they speak.
No, I'm picking that up now, and I was like, how could I have been that foolish?
Yeah.
So how are you guys doing? How are things? What's happening?
Well, to be honest, nothing much is happening this week. This week has been like relatively very stable for DeFi. Yes, we do not have DPEX. We have some banks falling left and right in Europe, but that's expected. You know, that's not
Yeah.
like a shocker or something. But in terms of DeFi, I think that things are quite chill. So
Yeah.
we did like a lot of like podcasts and stuff. Yes, in the like previous 10 days. But that's actually enjoyable, you know, like us being able to do something like this means that there are no like dramas in DeFi, like USDC going to 80 or something.
Well, it's good to be able to say that. I actually had a meeting with one of our corporate clients this afternoon, and they actually have been hit by this whole, this on and off ramp scenario in terms of, regional banks that have been friendly with crypto and kind of like this whole idea around choke point, and because that's a theory, right? It's kind of like this wild theory that's floating around at the moment. There's no confirmation thereof, but they've actually been affected. I mean, they issue stable coins. They're in the stablecoin market, and they are having to now essentially put the brakes on and reassess, partnerships and finding regional banks outside of the US that can help them. I think Coinbase did their homework beforehand, and they're obviously in a position where they can obviously go about their business. But businesses that were reliant on regional banks in America, for the most part, at this point in time, are not actually able to move substantial amounts of money on and off chain. So it's a bit of a problem, and it's going to be interesting to see how this whole thing plays out. And it also, I suppose, speaks to a lot of what it is that you guys are doing and what you guys are wanting to achieve in the DeFi space. It's almost like we're on the periphery at the moment, but there seems to be the right ideas. I like IPOR for the ideas that you guys have brought to the fore, and obviously we're going to speak about them today. I'm just waiting for everyone to join us. Darren, how are you, sir?
Yeah, good. I actually just got to Frankfurt, so maybe a couple of interesting things here.
Can't hear you, sir.
The day one of the conference, crypto assets conference, is quite well attended. All bankers, everyone in a suit.
Can you guys hear him?
Hello,
Ollie, can you
hello?
hear him?
I can
Yeah,
hear
I
him.
can.
Can you? Why can't I hear him?
Strange.
So weird.
Always had issues with Twitter Spaces. Maybe I can leave
I'm
and
going
rejoin.
to leave and rejoin. Ollie, take over, introduce yourself and all that jazz. I'll be back.
You're both planning to leave and rejoin now. Can you guys hear each other?
No, I can't hear him.
I can hear Jedi. Jedi
Let
can
him,
hear me.
just ask him to leave, and then let's see if it fixes it.
Okay, Darren.
Goodbye, friends.
Goodbye, Darren. Elon does not like you, obviously. And he's back.
Yeah, it's been a while.
Let's
hello,
see
hello.
how it's going to be now.
There we go. I can hear you.
Okay, great,
How are you doing, sir?
Okay, so I'm here in Frankfurt,
Hey, David,
and
can you guys
Oh,
hear me?
nice.
it's at Crypto Assets Conference. The first day is mostly from the regulatory perspective and about like CBDC, and then I'll be the second speech tomorrow talking about IPOR, and this is more of the DeFi and
Mm.
crypto assets day. But it's super well attended, so it's very strange and crazy to see, in this time. That there's so many, I guess, mainstream or what we would call TradFi, still thinking about crypto assets, and I think it's a great thing, and maybe it shows like you were talking about the banking. Banking, it's always been near impossible to get a bank account, right? And I'm old enough to remember Back to the Future, where Doc Brown comes in a car. He says, "Get in." He said, "What about the roads?" He said, "Well, where we're going there, we don't need roads." Right? And so, the question is, how far are we moving towards that kind of infrastructure? So, another thing is like Hong Kong, right? Hong Kong just announced that they're trying to really bring back, crypto companies, So I was doing business in Hong Kong since about 2015 in crypto, and I've never been able to get a bank account there. Actually, with my Hong Kong company, I was able to get a bank at Silvergate. So, that's no longer, right? But now you have Hong Kong that's really trying to cater to crypto companies. First, they kicked off, retail from trading crypto assets, and now they're trying to bring them back because they made the big mistake of over-regulating, back in the day, maybe 2016, 2017, 2018, and they lost a lot of ground to Singapore, and now they're trying to bring people back. So this is quite interesting. So you can see what is maybe the reaction to the reaction, where you have Hong Kong banks trying to now court crypto companies. So we'll kind of see how this plays out in the long run. But it's always been difficult to grab to have a bank account doing anything in crypto.
Yeah.
Yeah.
So, sorry, go Jedi.
No, go ahead, Dimitar.
No, I wanted to say that because like obviously like those problems with the banks, in the US is obviously like a pretty big problem because people are so entangled with the banks, and like everything that they do in crypto is somehow connected to the banks. But like, for example, I started my career in crypto in 2016, and it was in Shanghai, in China, yes. And I mean, for the majority of my crypto career, I have been based in Asia. And I just want to say that one thing that people might not know about Asia is that the majority of crypto business here is like entirely in crypto. Like people get their salaries in crypto. People can on and off ramp from crypto. Like people can buy an apartment with 5 clicks on OKX. Yes, you just go to OKX and you click 5 times for 200K each time, and you are done. And it arrives in your bank account, and nobody's even asking, because I guess like you're like smaller than a drop in the ocean compared to like what the Chinese e-commerce is, for example. So here actually in Asia, people are like already, you don't need roads. Like you can be completely entirely crypto and never need to touch like a bank. And even if you need to touch a bank, like you don't need to worry that every transaction of like a couple of $1,000 is being followed and that somebody's going to knock on your door. Hence why
So
USDT is so powerful.
yeah,
It's because
USDT's
all of Asia is using it.
yeah, and people don't realize that. People like ask like what relevance does Tron have and what relevance does that network have? But what they don't realize is that there are entire continents that actually operate off the back of that network. And Justin Sun, even though we make fun of him and he's always doing the silly things that he's doing according to our perspective on things, he's definitely like in the palm seats in terms of that network and the market that it caters for. I mean, I can totally relate to that. I've done a lot of business in crypto over the last 10 years in terms of transacting in the gaming space, because I was one of the first to get involved in trading in games like Ultima Online and World of Warcraft, and the way to transact in those games back then is if you were buying somebody's account, you used Bitcoin. I mean, it was just one of the currencies that we used, and then as soon as stables became a thing, it was USDT. I mean, that was like one of the first things that we used over and above Bitcoin. I mean, I know that Darren, you've been around for a long time. Dimitar, when did you first get involved in the crypto space?
Actually, much later. Yes, I went into crypto in like 2016, but like from the moment that I entered, I was like already like deep to the waist. Yes, like full time doing nothing but crypto, like 20 hours per day. So I actually started on the banking side. So I was working for an investment bank. I was doing portfolio management, and then the bank decided that they're going to launch a crypto product. And me being the most intellectually curious person and already having like a little bit of understanding about it, I kind of like spearheaded that product, and which was basically a wallet for the banking clients, which is connected to Kraken. So basically, they could have do with their banking application, they could have trade crypto, and on the back end, we just settle those transactions directly on Kraken. But very fast it became apparent how difficult it is to try to scale up that business, because like the onboarding cost and time that it takes like just to get like one user is like the cost is massive, and then the time, all the KYC AML procedures, you cannot get people unless they're from some white countries. Yes, unless they're like Europeans. You try to get somebody from Latin America or Africa or Asia, they are never going to pass the checks. So that became very annoying very fast, and I'm like, okay, I want to do like real crypto. So I started doing like spot exchanges, and I actually was working in like the oldest on-ramp in China, yes, back then.
Okay, so I suppose the obvious question now would be, IPOR, Darren, Dimitar, how did this all come about? I mean, and where did the idea come from, and how did you guys actually go about doing it? I don't know if, Darren, you want to start the first part of the story, because I'm sure it's an interesting one. I haven't actually really heard anyone ask this. I'm really curious as to, what brought it about and how you guys met and what brought you guys to this point.
So I've actually talked about the origin story multiple times from my perspective. So maybe I actually like to hear Dimitar's perspective. But how we met really quick is a bit funny. So actually, we met in the Frankfurt School of Business and Finance, where I'm sitting right now, in 2018. And on that time, I spent 2 years building security token infrastructure, because personally I'm an idealist. And I'm also a rationalist, right? So idealist, I build what I think is going to be the future. And then rationalist is trying to figure out where everything's going, right? It's more, so the security token infrastructure, regulation it's always going to come. The question is, will we ever have clarity? And that's a very big, difficult question. But on the security token side, it's regulation first, which means that actually crypto it's a nice to have, but not a must have, because you already have very strong rails in the security space. And so I was speaking on the panel, and there was this very large gentleman who when they asked a question, it was actually on an investors panel, and a large gentleman in the back stood up, almost 2 meters tall, in a very thick Eastern European accent, and he said, "Why do you want to take everything that's good away from us when we built this industry?" And me, I'm looking at this guy and I'm like, "Listen, man, I agree with you, but what do you want me to say? Look at where we're surrounded by the bankers, by the regulators." And that person was Mr. Dimitar. So that's our meeting story in 2018. And then maybe you can tell the story about the IPOR innovation.
Yeah, yeah. Okay. So yeah, it's true. We met there. I actually, I left like traditional finance in 2017, and I instantly went like very, very deep into crypto. Yes, I started like research on, bonding curves, DAOs. Like I was so fascinated about the idea of DeFi. And back then, because I was operating spot exchanges, and there was that big theme, which was about transaction fee mining in the Asian spot exchanges, and it was massive. Yes, we had like exchanges that come out and they start doing like $1.5 billion per day in volume, based on basically that game theory gamification of like how basically the exchange is going to reward some tokens that have some utility to people that trade. Yes, so a lot of wash trading, a lot of like dodgy stuff, but it was fascinating. And I was already so deep into it, and then we met on that conference, and like everything that they were talking about for me was like, why do that? Come on, like you're just going to corrupt it, you're going to make it very bad. And then basically how I pour, like for the next 3 years, actually I was a VC, because I really wanted to work with many founders. I wanted to support projects, and back then there was no real DeFi. Yes, there were just like projects which are trying to build like the base infrastructure for DeFi, but you could not really like make money with DeFi, because there was way too little users. Yes, way too little economic activity. And then the moment when DeFi summer came, I instantly left VC. I started like power farming for myself. Yes, I just wanted to go there and explore all of the projects. Obviously, VCs were very, very slow to adopt DeFi. They only started going in like much later, like middle of 2021. But basically, by the end of 2020, I was already like very happy with everything which is happening in DeFi, and I started thinking right away, like, okay, what what can be done? Like, what are the problems in DeFi? Like, where do I see it going? Yes, and meanwhile, we kind of like reconnected with Darren, because he also wanted to explore DeFi, and I was kind of like running those knowledge groups, like me sharing like what I think about different protocols, about their liquidity mining, about their tokenomics. So that's how we reconnected and started talking again with Darren. And he was like, he basically spoke something about an index, yes. And he's like, what do you know about LIBOR? I'm like, very, you know, I know what it is, but like not really a fan of interest rates. It's not what I have followed. Yes, when I was doing like portfolio, I was doing like funds, companies, equities. Yes, not really bonds and interest rates. But then he basically spoke about the idea of like to create like a benchmark for interest rates in DeFi, because we were talking a lot about the credit markets and how important it is to know like what is your cost to borrow, because back then that was the play. Yes, you borrow money and then you go and you farm different protocols with that money. But then many times it would have end up like that. Actually, the profits that you make barely cover your borrowing cost. I don't know if you remember back then, but the average cost to borrow back then for stables was like between 10 and 20%. It was not like now, like 2 or 3%. So it became apparent that this is something that we actually would need if we want to see like DeFi scaling. And so when he said about the index, and basically I cannot really remember who gave the idea for the interest rate swaps. Was it Darren or was it I can't really remember, but I mean, Darren, do you remember? Did you give the idea or did I
Yeah,
give
well,
it?
I wanted to do interest rate derivatives in general, and then the swap. Like the question was how to construct it, right? And so we did a lot of research about who else was building in the space. A couple of people had tried it with an order book mechanism, and okay, it makes sense, but we need to really like piece the best of TradFi and best of DeFi. right? Take this really liquid instrument, this very standard instrument, one of the ones that's the most traded in the world, and slap on a liquidity pool and AMM to bootstrap a two-sided market.
Yeah. And then we started. He started actually writing the first sentence of the white paper in, like, what was it, like 31st of December, 2020.
Yeah. New Year's Eve 2020. Yeah. Started with the abstract, which you always end with the abstract, but
yeah. He started, and then I think that our team was already like assembled by February. We were already like building.
Okay. And in terms of the motivation behind it, you obviously have spoken about IPOR. Just a quick summary. I mean, for those people who might listen to this podcast later on, or this recording later on, what is IPOR doing and attempting to do in the context of interest rates and DeFi going forward?
Yeah, well, let me kind of give a preview to the talk that I'm going to give tomorrow, right, in front of the banks. So let's look at actually something very. So we're crazy about interest rates in crypto. We love the Fed prints, and everyone is watching. It's going to be 25, 50, 75 basis points, right? It's going to go up, crypto's going to crash. If it's going to go down, everything's going to moon, right? So everyone's crazy about interest rates in traditional finance. So we're crazy about the central bank rates. They're also crazy about a couple of the different economic indicators, but no one gives a shit about interest rates in DeFi because people are too degen, right? But interest rates rule everything around us. So let's look at something like the collapse of Silvergate or Silicon Valley Bank. Both of those two, if we really simplify why they failed, there were two risks that they couldn't cover. One is duration risk, and the second is interest rate risk, right? So in both scenarios, what they had was they had the customer deposits that were locked up in long-term assets that they had to liquidate at a discount, which caused a balance sheet hole. They also weren't sufficiently hedged, so that exacerbated the problem. And when they had to pay out the short-term depositors, then that put them in a liquidity crisis, right? So there's two things at play: duration risk and interest rate risk. And if we build on the parallel structure, let's turn that around. So we don't have duration risk in DeFi. We really don't. The only thing that we have maybe is the duration risk of staked ETH and the Shanghai hard fork, and that's about to expire hopefully here in a couple of weeks, right? So it's also useless if we don't have durations in DeFi, because we'll be stuck with these like very liquid money markets that are useless because you can't do anything with them except for speculate and leverage in the short term. And that's really not productive. It doesn't really do anything for society. It's really useless. But, if we look at something like the IPOR currently, it's a spot price. It's the spot cost of credit. It's the cost of credit at the current block height, right? And so this is really useful for now, but we need to get to a 1 month IPOR for USDC, a 3 month IPOR for USDC. How much should it cost to borrow, USDC for 3 months, 6 months, 1 year from now, right? And this is what we have. We start to develop this term structure in DeFi so that actually we can start planning longer duration instruments, right? So then you can go from, taking a flash loan to taking a 1 month loan, to taking a 1 year loan, to be able to take a 5-year car loan, to finally get up to take a 30-year mortgage. But you won't be able to get there unless you have a couple of things: term structure, a yield curve, and then interest rate derivatives to be able to hedge your risk, right? So, going back to the two banking crises, the very issue was the Fed hiked rates to slow inflation. If the Fed hikes rates, the bonds lose value, right? So they have this, convex structure. So the banks weren't hedged, and this is what caused all the problems. So interest rates are a big deal in TradFi. They're a big deal in DeFi, but people don't think they're a big deal. And until people start basically managing their interest rate risk, we won't have any maturity in the space. So it will be this nice little sandbox where people are having these cutesy, like one block loans to try to exploit another protocol, but they'll be really useless because they won't be useful for something like a home loan. So IPOR is two things. It's the development of term structure in the IPOR index and transparency around interest rates, and then tools to manage interest rate risk.
Thank you, sir. Thanks for that breakdown. And I mean, obviously, the whole thing is starting to already evolve. I know that you guys have started adding a whole lot of new products into the mix. I've got Ollie here, who's actually recently joined the Blockmates team, and he's been researching IPOR specifically. And I know that he was obviously interrogating this over the last few days, and I know that he's dying to get stuck in. Ollie, welcome to your first spaces with the Blockmates crew, sir. Well done. You made it this far.
Hi, thank you, Jedi. And
Yeah,
yeah,
man.
like you said, I've been dying to ask Darian and Dimitar, some questions, especially around the new stuff, which is basically, power tokens. I'm really fascinated about them. But I'll not be doing like, the audience any good if I don't give them the opportunity basically to understand like what the power tokens are, like from the very base of it. So I think Darren, if you can help us, probably explain, what power tokens.
That's not me. That's Mr. Dimitar.
Dimitar.
Yeah. Okay,
Okay.
so yeah, like very, very, very simply, yes. Power tokens is basically the most simple way to say it is like me looking at like all of the distribution methods that have been happening in DeFi. Yes, obviously I have very long experience of looking at this. I was writing papers on token economics back in 2018 already, and I have seen thousands of projects. Yes, up to a point where I can just open a Git book of a project. I can go to their token economics page, and I can basically say, okay, are those guys going to be successful? Are their token economics extra aggressive? Are they value extracting? Are they simply looking for exit liquidity? And you can really judge a project, and like you can judge the mindset of the people that are building that project, whether they are just looking to get like fast money, or they are actually looking to build something, to create something valuable for the space. And I mean, not 100% of the time, because obviously, a lot of DeFi founders, they might know the tech, but they do not understand token economics. This is like a completely different field, which also like requires a lot of experience. So power tokens is basically me looking of all of that value extraction, which is happening by basically insiders or mercenaries, whales, and how it basically prices out retail from the equation. And now we can already see it. Yes, like the majority of retail is not participating actively in protocols. What we see is a lot of retail people which are simply going there and they're buying some token, hoping that is going to 10x or 20x, like just purely for speculation. But very rarely you're going to see like retail which are active protocol users or liquidity providers. Again, unless it's required to be like a liquidity provider in order to be able to speculate. Yeah. But that's not how it started. That's not how DeFi started. Yes. DeFi at the beginning, you had the ability, to go and contribute to protocols, and you were earning very competitive yields. Yeah, you were earning something like 10, 20, 30%, because DeFi is very generous in general. Yes. So you could go there and just farm 20, 30% on your portfolio easily, and then potentially with an upside But as things evolved, you have like you have those parties that basically go there and they try to extract all of the value. So those parties are usually either going to be, some whales with massive amounts of money, or it's going to be like insiders, like VCs and the teams themselves. And I was looking of how to fix that problem, because for me, what I wanted to create is like a protocol where if you are a normal retail DeFi user, with some stables in your wallet that you don't know what to do with it, yes, you want to put them to work. I wanted to build a protocol where you're going to be able to earn competitively, yes. So Power Tokens is basically this: optimize token distribution, build the game theory in such a way that it would allow, basically, like they call them fish, yes, to compete with the sharks on equal grounds. Well, it's never equal, of course, like not to shoot too much here. Everything has flaws, etc., but it's a very, very good attempt to basically create a very competitive protocol for yield on stable coins. And yeah, that's really about it. If you want to dig into some specifics, just ask away, because that way it is going to be easier.
Yes, Dimitar, I must actually say that I'm very fascinated about this, and um the story is even more fascinating, given the fact that you're truly concerned about the activities around these protocols, and anybody who basically is very much interested in DeFi can actually see that this is sort of like a serious problem, like a serious issue, where we have most protocols and the players around those protocols are usually whales with some size, right? And people with probably lower liquidity are just left out, or should I say retail liquidity are basically left on the side, and basically just have to speculate around the tokens, right? But I also get that power tokens are sort of like open source token technology, and you guys have built this as some public good. So my question is, um, what interesting ways are you looking forward to seeing power tokens used, just beyond how IPOR is basically using it right now?
Yeah, so at the beginning, power tokens was built specifically for IPOR. Yes, when we were building the concept around power tokens, we were optimizing it basically to serve the use case for IPOR, for our own protocol. But what happened is that during that time, because this was like a very long process, yes, it took like many months to come out with the design idea for power tokens, like the entire architecture, and then like the game theory around it, the whole token distribution and liquidity mining, the boost. This took like a lot of work and a lot of simulations to get there. And during that time, it was just like, it seemed that we were like really we were in time where DeFi token economics were not evolving at all. It's like the entire industry was stuck at basically V tokenomics. And I could see many projects, many protocols that are launching, and because they don't know any better, or they don't have the right talent to build their token economics, they were just going the route of like, let's just put V tokenomics. Yes, let's do exactly the same thing with our own token. And even though they have different distribution, they have a different protocol, they probably do not even have like the need to have gauges. Like obviously, V tokenomics work for Curve. That does not mean that they're going to work for your protocol. And during that time, we were having like a lot of discussions in Lobster DAO, and I was one of the people that was very vocal there in that Telegram group, like, guys, V tokenomics suck. Just stop looking at them because it works for Curve. It works for Curve because Curve is a fucking amazing protocol. That does not mean that it's going to work for you. And 6 months later, basically people came to the realization, yes, indeed, they don't really do as advertised. Yes, and by advertised is like, oh, you expect that simply because you introduce V tokenomics, you are going to have like the same success as Curve. And people were frustrated because they literally did not know what to do. And then there were many protocols that did not want to launch their token simply because they did not know what to do with what to do with their token economics, because you don't have like that easy copy paste. You don't have that success case that you can justify in front of your community. So then was the realization that like this is actually a very big need in the space, and it's when we started like moving basically power tokens to be like a public good. So the whole architecture is created in such a way that a project can go there. They do not need to copy paste exactly the same things that, for example, IPOR did. Yes, the architecture is very modular. The logic is very well described in documentation, and it's easy for you to basically go there and adjust the different modules to serve the specific use case of your own protocol. Yes. So, and this is very important because when you copy paste something like vCurve, yes, you're literally left with this. It's very difficult to make changes after that. It's a very complex system, that system is not created for other people to be like user friendly for other developers to use it as a framework and then build on top of it or change it. It's a very crude system. And once you implement it, going back or trying to do something different is going to cost you actually much more effort than building it yourself. So that was the realization. That's when we decided let's open source it so other people can use it. And that's what we did. Yes, we wrote very good documentation. We audited it multiple times. We have it open sourced on GitHub, and anybody can go and look at it and check it out and see whether it fits to implement for their protocol.
Yeah, really, really incredible work, Dimitar, honestly, because I think that what you guys are doing basically is not just thinking about IPOR in general, but also looking at how the space can evolve and how we can have more protocols who, consider the specificity of their project, right? In accordance to how their token design basically, and just use the power token approach, right, to just like do modify it basically in real time. So I wanted to sort of find out, because I discovered that IPOR this year, like, it's in your plans basically to work on the DAO structure of the project, or basically take that more personal and or more important. So I wanted to find to ask, because I'm curious, like, how you implement IPOR's native power token. That's the PW IPOR. How how is it basically implemented, and how does it work? How does it function? In accordance to the current state of your of your project, basically.
Well, so exactly to showcase how easy it is. Like, you can think of it like the governance part of Power IPOR is simply another module that you add to the core logic of Power IPOR token. Yes, so you have the core logic of Power token, and then you have all of the modules that link to that core logic. So in a way, when you're creating your module, which is for the governance, which basically measures who has how much governance power, yes, for on-chain governance, you can input whatever logic you want there in that module, and it's going to be completely autonomous from the other modules. So this is one of the biggest strengths. Yes, you are not tied to like, oh, you know, I'm going to have a governance token with voting power, but at the same time that token is also giving boost, and at the same time that token is also giving dividend, and like you try to balance like one unit of token to be equal for all of those activities. Yes, you can have one unit of token be for boost means something, for governance means something else and might even be increasing in time, for dividends be something else and might even require some redemption period. It's like every module is completely autonomous. I don't know if that makes sense, but it's extremely easy.
Yes.
Yeah,
Okay. Jedi.
go ahead, sir.
No. You can go ahead.
I think for me it's just understanding how it all ties together, because you know you've got so help me out here. We've got the interest rate component of it. We've now got the power tokens. We've got the effort around building around this idea for good, and there's also the aspect of earning yield over a period of time. How does this all tie together? Like, what are the mechanisms that are at play? I know that this is quite a big question, but as simply as possible, how does the whole ecosystem work in its entirety?
Yeah, maybe I'll try to take this one and break it down into different actors, right? So first of all, there's the index, and everything revolves around the index. That's why the protocol is the IPOR, Interprotocol Over Block Rate. And this is the start of term structure and start of yield curve in DeFi. So think of the IPOR interest rate swaps that are currently on chain as the first instrument that references the IPOR. But there might be hundreds, thousands, millions of instruments, you know, in huge values that actually call from their smart contract to the IPOR Oracle smart contract to structure a deal, to structure a debt instrument, to structure a different derivative, right? And so that's the end goal. The end goal is that there's this transparent benchmark rate on chain that's used to structure and support, you know, this huge ecosystem of credit inside of DeFi, and that's the end goal. So the IPOR's success, the success of the IPOR protocol will be judged by whether there is all of this value, you know, that's using the IPOR interest, the IPOR index to structure deals. That's the end goal. Okay, so inside of the ecosystem right now, you have, let's talk about the derivatives, right? You have traders and you have depositors. Depositors are essentially passive underwriters. So they place a stable coin and that money goes out to the money markets, but it also underwrites swaps, right? So they're a service provider and they're the market maker. The AMM prices the debt and the trader's going to come and trade it, right? So this is the derivative stabilizing layer. So if you think that you can put this together into kind of one big picture, like let's imagine a skyscraper, right? The skyscraper, it builds up into the sky, but unless you have a very deep foundation, you can only build so high. So this data layer is like the very, very kind of base footprint, or you know, of the. It's like the pillars. It's the foundation. Everything pegs to that, and then you know you fill in the foundation with the derivatives that you know that keep it from rocking when there's an earthquake, right? It stabilizes the market in terms of volatility. So that's the function of the derivatives inside of like a software stack or like a credit, you know, if we look at the credit markets as a software stack. And then how the whole social element goes together is there should be, it's essentially the IPOR DAO that governs the structure of this interest rate benchmark that lives on chain. Right, so what does that look like right now? Well, at the beginning, there was only really IPOR Labs that's building the protocol. But there's 17 of us on IPOR Labs, and now there's 14 people called IPORians IPORians are the ones that are in the IPOR Discord, and they're contributing to the formation of this protocol. And these IPORians are receiving something called IBI, or IPORian Basic Income, which is essentially a stipend that's subsidized by the IPOR DAO. It's coming from the DAO Treasury, the DAO Operations Wallet, right? So now you have 17 people working in IPOR Labs, you have 14 people that are in IPORians, and you have this huge community of citizens of IPOR that are that are starting to get queued up on what the protocol is all about. Now, how does this go form into a DAO? So I think maybe this week or next week, there is a Discord native forum that's a governance forum. And this has been trialed out internally. And for example, there's already a work group up between some of the IPORians, some people in IPOR Labs, and other DAO contributors that are working on an economics group. And what is this economics group doing? Well, the first mandate is to figure out what to do with token emissions. So token emissions were set to be a certain amount, so that's 10,800 tokens per day for the first 3 months. We'll hit the end of the first 3 months, here, I think on the 25th of the month, and then they'll be modified. So who decides on that? Well, this DAO work group. So if we take this DAO work group, that's the economics group, right? So they'll probably work on things like token emission, tokenomics, right? If you look at the IPOR index, you have a couple different things in play. You're talking about people doing quantitative models or data science. You're also talking about data propagation. How do you tap into smart contracts that are living on another chain in case another interest rate gets ingested into the IPOR index, right? So you'll probably have a working group around the IPOR index itself, and it will probably need to be comprised of people with this kind of background, which is data science, data propagation from the engineering perspective, from the quant side. You'll also have maybe like a financial working group, which is not just the economics, which is the tokenomics, but you're talking about managing the financial risk on the derivatives. So there's already this formation starting with all of these different kind of work groups that can focus on one part of the IPOR protocol. And this is very, very quickly moving towards, this staged decentralization. So maybe it's not such a clear picture, concise, but it's like every part of the IPOR protocol can be so complicated and so complex that, there's different groups that will kind of govern each part of this protocol, and it's already stepping very, very quickly towards this decentralized future.
Yeah, I definitely do get the impression that, and that's obviously why I asked the question, is that there are so many layers to this whole thing. And I think the biggest challenge for IPOR is obviously the educational aspect around it, because what you are grappling with is something that's quite foreign to, the DeFi native community, as you so eloquently put it at the start of this chat, and that is that, people don't think that fixed interest rates are anything important, but we've obviously established through this conversation that they are. And I think the question that keeps on coming back to me around, that mindset is, how do we educate and inform even founders that don't believe that the fixed interest rate aspect of the space is relevant and important? I mean, how do we address that issue? Because I would imagine that change needs to happen with founders and projects going forward, that they at some point need to acknowledge the importance of this thing and incorporate it in the very kind of mechanics of how they manage their protocols. Or is that just me being idealistic?
No, I mean, maybe I'll touch really quick on this, and then I'd like to hear, also what Demetrius has to say. But think of the idea of risk, right? So, Demetrius was talking about all these times where you can get 20% per annum easily, supposedly easily, but with a collapse of something like, Terra, people with Celsius, with FTX, people ask, okay, where do the yields come from, right? So they're starting to think about risk in ways they hadn't ever asked questions before. It's unfortunate, but I'm really glad that it's happening. So think of the IPOR as the risk-free rate of capital in DeFi. And if we define risk-free in terms of the very low risk, over collateralized money markets that take Ethereum, for example, or a very strong asset as collateral. So that is your risk-free rate in DeFi, right? So for example, if the IPOR rate is at 2% and you're getting 15%, you say, okay, this is not a risk-free rate, this is a risk-adjusted rate, and you realize you can lose all of that because of some malfunction, because it's not sticking really to this kind of market rate. So it's a great framing, for risk, and then you can use it for very low risk strategies. So DAO treasuries can, they can use IPOR swaps to hedge their money market risk because they're lenders. They're the big fixed income players. IPOR Intern wrote a huge 2 or 3 part series about, how DAOs are the fixed income players. So what they would do is they take the stables in their treasury and they loan them out, and they take a receive fixed swap because they want to hedge their downside risk, because they need a stable rate of return. So this is some predictability for their operations. Do you mean?
Yeah, from my perspective, like how can we, like, definitely it's a question of like educating, but I don't think that you can force people to care about something specifically in DeFi. If people just want to degen on strawberry coins or 100x on perps, it's very hard for you to convince them, well, you should care about something else though. But what, for example, we saw, what we saw in DeFi even is that, like, we started from credit markets. Yes, we started the entire thing with Compound, and then Aave. And then a little bit later, we had like Curve, which is that stablecoin DEX. And then we had probably like 1.5 years of various experiments with other products that basically turned out to be like unsuccessful or not profitable, or both. And then we came back full circle to basically having now majority, I would say like 90% of DeFi is again like credit markets. This is where the actual economic activity happens. Yes, you have people that lend, you have people that borrow. There is value exchange between those people, and then we have like some perps like GMX, which we are always going to have, obviously, because people want to degen as well for the adrenaline. But now we cannot just like we cannot just fake decentralized finance constantly with just like farming new tokens, that with new Ponzi-nomics and so on happening all the time, because majority of them fail. Yes, yeah, you hear about one, you don't hear about 1,000 that fail. So at some point, people are again going to go back to the basics, and I already see it. Yes, like I see it from like participants. For example, now the way that they judge protocols when they engage with protocols is like, okay, what is the actual real yield that this protocol is building? Don't tell me what is the APR in their own shitcoin, which I know can be, heavily gamed and Ponzi'd and pump and dumped. Tell me what's the actual real economic activity and what makes money of this protocol. And we're getting back to this scenario now where people are searching for that. And once this is the case, once everybody have burned out, everybody have played with enough shit coins and have got hacked on multiple chains with multiple like dodgy projects, they're going to go back, and then we will need to scale that space. Yes, but in order to scale it, in order to be able to build like more complex products, yes, like for example, let's say something like Gearbox, being able to go there, open a credit account, and farm on leverage different protocols. Yes. Now this works when the interest rates are like 1 or 2%, because when the interest rate is like 1 or 2%, it's unlikely that it's going to interfere with your leverage strategy. Now, if your interest rate is like 7% or 10%, and you are trying to execute a leverage strategy like this, you're basically leveraging on those 10% because you're borrowing 5, 6, 7 times more. Yes, so now it's not 10%, now it's 70%, and you need to make up for this with your strategies. So either we are going to have like absurd, yields and like real yields that are being created across the DeFi space, or people will need tooling in order to be able to lock their costs and basically execute their strategies based on the knowledge of like, okay, how much will I need to pay in the next 2-3 months in order to take advantage of that strategy. So I think that this is going to be something that's going to happen naturally. We can try to push it. We definitely are trying to educate people as much as possible, but you cannot force beauty. Yeah. So it's just going to come with time. Yeah, that's really about it. That's my point of view, at least.
Yeah, thank you. I think that is quite eloquently put, because I think there is that moment where you do have a realization that maybe the whole shitcoin space and all of that stuff, I think for the most part, you reach that point where it's kind of like, well, what is actually the point of what it is that we're doing here? And there is a lot of point to what it is that we're doing here. It's just that you got to look in the right direction. I think that's the reason why you get kind of like the Bitcoin maximalism in its state and the way that it is now. But I also get the feeling that there are substitutes for that kind of Bitcoin maximalist kind of mentality, where we're starting to recognize that it's not just about money moving from point A to B. It's actually about money working in a space where we are obviously accountable for it. And products like IPOR endeavor and seek out those kind of solutions. And then there's a whole lot of other products. But interesting that you brought that up, because I think that is very important around the educational process. And what I'm interested to almost investigate and to interrogate going forward is, how do third-party protocols use the IPOR fixed interest rate model, per se, for lack of better terminology, to actually incorporate it into the borrowing and lending market on those fixed interest rates? How do you see that dynamic working outside of IPOR? Because I know that at the moment it's kind of like you guys are associated with IPOR as individuals, but the intention is to move away from that and for it to be almost like an autonomous organization where that IP is then utilized by other protocols and by DeFi as a whole. Is that correct? Is that what the goal is of what it is that you guys have built here?
Yeah, it's really hard to conceptualize benchmark rates and interest rate derivatives, right? For the
Yeah.
average person, for people inside of finance, right? So, I was back in East Denver and I was talking with my folks. I'm originally from Colorado, and I was telling them like what I do, and they see it. They're like, "Yeah, it's crypto, right?" And I'm like, "No, actually, we're doing something with interest rates on stablecoins, which are representatives of the U.S. dollar." And for them everything is crypto, which is Bitcoin, which is everything else, right? And I'm like, okay, so let me break it down, right? You guys took a loan to buy a house, right? Like, yeah, okay. So you've actually dealt with interest rate benchmarks and interest rate derivatives. You just have no idea, right? So all loans are based on some benchmark rate, right? This is they called the LIBOR the most the most important number in the world, because it had hundreds of trillions of dollars in deals, debt, and derivatives that are tied to it, right? So you need this transparent benchmark rate as a tool to say, okay, credit is worth this much, right? So then you can offer an instrument for a certain period of time at this rate because you can actually get it from the market at that rate. But in case the interest rate goes up or the interest rate goes down because of something something that happens by the Fed, some idiosyncrasy between the different stable coins because we're in a risk on and risk off environment, you need a derivative to hedge that. But these are like the really like they're the things under the ground, like they're the foundation of a skyscraper. You never really go into the basement, you never go tunnel down to see what's down below, right? In a car you never think about the suspension, right? You never think about the shocks, but they're the thing that keeps the whole thing moving, right? So in the end, I don't think a lot of people will really understand that they're dealing with the IPOR protocol. The IPOR protocol will be this invisible layer that just keeps everything together, down, deep down into what's the cost of credit and how do you hedge this interest rate risk. So I don't know if it's really education around the IPOR protocol that's so much needed. It's more that we're looking at building other more complex structured products just using the base IPOR the IPOR tooling, which is the index and the derivatives. So I don't think actually, my bet is that it won't be mostly traders that are trading the derivatives. It'll be smart contract to smart contract calls, more complex products. So whether education is needed or not, what's needed is that, we start building different composable products on top of the IPOR based stack. And, that's how it becomes useful. And you may not ever know that you're using it, but if you go to a DeFi bank to take a home loan and you get your, 30-year mortgage at 3.5%, right? Who knows? But there's a good chance, that this is going to be structured off of one of the IPOR rates. It's going to be stabilized or secured with one of the derivatives, and the in-person is never going to know it. And that's okay.
Yeah, maybe to expand a little bit here on like a little bit more from like DeFi perspective. Yes, like when we speak about credit in traditional finance, yes, the amount of money is virtually unlimited. Yes, you have like an infinite amount of money which is willing to be lent at a specific price. Now in DeFi that's not really the case. Yes, if we see like on chain, the amount of stable coins that we have on chain is like 1/20th or 1/50th of the amount of the actual circulation of those stable coins. So actually a very small amount of the stable coins are actually circulating in DeFi. And obviously that's also like hindering basically the growth of economic activity. So mostly this is caused by the like semi-bear market that we experienced, with Ethereum going from 5,000 to 1,200. Obviously there was like a lot of deleveraging, a lot of centralized parties that were actually very big lenders and borrowers went bust. So all of your BlockFis and Alamedas and 3ACs and so on, they were like actually pretty big participants in DeFi. They went bust. So we have like billions of dollars that disappeared from DeFi because of that. And in terms of like specifically DeFi constructs, yes, it's very difficult because the amount of money is not unlimited like in TradeFi. It's very difficult to create like a fixed rate protocol. So obviously both Aave and Compound, when they started, they both had the idea of like, yeah, we are going to offer like stable rates, like fixed rates. And they went away. They went away from that construct because, again, there is not unlimited amount of money. So they need to optimize for liquidity, because you have the situation where people cannot withdraw their money from the credit market simply because all of them have been borrowed, or there is a situation where somebody have went there, have borrowed like 70% of the utilization at a fixed rate, and then because of the of the curve that they use to set up the interest rates, everybody else after that need to borrow at like, instead of 2-3%, they need to borrow at 15% or 17%. So both those biggest credit markets, they went away from the concept of trying to offer a fixed rate. So we are only left with variable rates. But like what Darren was saying, like you cannot run complex products, complex DeFi products, financial products based on variable rates. You need to be able to fix that. And IPOR is really that thing. Like you don't need to try to create like a new fixed rate credit market and try to bootstrap it and try to attract like hundreds of millions of dollars inside for liquidity or possibly billions of dollars. You can just use the variable rate, fix that rate via IPOR, via derivative. IPOR already have basically done the effort to be able to give like an LP pool which is willing to underwrite that risk, and it's willing to underwrite that risk at a very small premium to whatever the variable rate currently is. And that's the whole point of having all of those quants and like all of those like calculations for the spread of trying to estimate what is the fair value of that interest rate swap for the next like 1 month or 3 months. So this is what I see is going to happen in DeFi, because right now we have like credit markets which are launching one after another, and what they do is like all of them are using exactly the same interest rate curve, which is based on utilization. Yes, 0 to 80%. 80% is the king. If utilization goes above 80%, it like the interest rate starts to increase like from 4 to 100% the borrowing rate, and all of them are doing the same thing. And this simply is like you need to have something that you basically take as like what is the default state of the cost of money in DeFi, and then build your project based on that. Build your protocol based on that. Don't try to bootstrap everything with like market dynamics. So this is where I see that IPOR is really going to be very useful for people launching any form of protocols which are related to some form of yield in the future. And maybe a little bit of front that really Aave and Compound should do something about that interest rate curve. It is just ridiculous that rates in DeFi are like 2% or 3%. That's I wouldn't say that this is the real cost of credit that we should have in DeFi. And I think that this was created like that because back when those protocols were created, the interest rates in traditional was something like 0.5 or 1%. So if you apply the risk of DeFi, yeah, you can put like 4 or 5% on top of that. But right now, basically to sit on those interest rates, I don't think that this really represents the fair cost of money in DeFi. We definitely need an improvement there of how we are setting up those interest rates based a little bit more on like supply demand and not have those shocks of like somebody decides to borrow like $50 million and then suddenly everybody else have to pay like 70% borrow rates.
Gotcha. Got someone up here who would like to ask a question. Ben, who's a frequent contributor to Blockmates. He also is part of the Tapioca DAO team. And yeah, Ben, welcome. It's good to have you, sir. It's been a while since we've chatted. Welcome.
Yeah, I've been. Can you hear me?
Yeah, perfectly.
Awesome. Yeah, I've been listening to the discussion. I think it's good to hear you guys take, because I mean I do think you guys are trying to do something very unique in the space. And I've heard it likened to like something like a LIBOR for DeFi. But it's, I mean, I guess my first question would be, do you kind of see it that way, or do you see it more as like a repo rate or something more like that, or?
Yeah, it's more like a repo rate, right?
Yeah.
So, and it's a mid-market rate. And the reason that we went with construction wasn't necessarily because it's the best case for the IPOR, but it's because of the limitations of the rate dynamics on Aave and Compound, right? The lending and the borrowing rate. And so the question was always how to, do you build an index per rates? Do you build a lending and a borrowing index, per market? Do you build so we went with the mid-market approach. It is much more like a repo rate. And I mean, some of the design constraints that you have in DeFi are because of the constructs that you get from other protocols.
I guess my question is like, what is the advantage you see like having this as like kind of a DeFi wide thing versus like a protocol to protocol sort of more bespoke, uh, you know, interest rate?
Yeah, well, if you look at, so, a lot of people, there's also like volts, for example, that's probably the closest thing similar to IPOR. And they really went with a market to market approach, right? So, kind of one index per market. And that really helps you hedge kind of basis risk on a single market. But we're really looking at DeFi as a broad construct, right? So for this thing to be useful, all the rates kind of have to come in line with one another down the line. Otherwise, that means that the inefficiency is not being arbitraged, and two, it's not being arbitraged because you don't really have instruments like the IPOR derivatives to bring it all in line. So really, the broad scale is that everything should really come to the IPOR rate because that's the most liquid markets. Anything that are outliers should be arbitraged away. And so everything should, I guess, converge to the IPOR because the IPOR is the rate, not because it sets the rate, but because it reads basically the state of the most liquid markets.
Gotcha. And I mean, do you think that, it would make sense to have more of like separate rates for separate collaterals? I mean, because I think like, in repo you have sort of general collateral rates, but then you also, for it's more premium collateral, you can get lower rates of and so like I kind of see something like that in DeFi where you have deeper, more liquid markets such as like ETH or WBTC that are going to obviously have better rates than somebody borrowing against Curve or something like that.
Yeah, well, sure. I mean, the IPOR rates first are across the most liquid, the stable coins that are most borrowed. And the reason that we had the IPOR for the USDC, USDT, and DAI was because it was the only asset being borrowed, right? So we could do it we have internally we have a IPOR rate for ETH, but no one's borrowing ETH. Everyone posts that as collateral.
Yeah, that's fair.
The other side of it is that actually, so we wanted to focus on these kind of single markets for. So one of the risks, and actually we were looking at a lot of the, what were a lot of the risks of moving away from the LIBOR, for example. And it was the idea of illiquidity risk in case that you go with a number of benchmarks, because then you'll fragment these liquidity across a number of indices, which leads to liquidity risk and more volatility risk in kind of those disparate indices. And so we wanted to actually recreate the value proposition of the LIBOR in having a single benchmark with collateral that is aggregated, right? So, for example, if you look at most of the all of the kind of yield stripping protocols, their native collateral is like the A tokens or the C tokens, right? But really, that's fragmented collateral. So the people that can be active in those markets are, people who have primary positions. And if you look from like a user funnel, someone has to have a primary position. Out of those users, someone splits, and then that's the limitation of your market size. Whereas in the IPOR instance, we have aggregated pools. So anyone with USDC, USDT, or DAI can be a liquidity provider or essentially a rates trader. And so it creates a more open construct, but it also limits some of the composability. And these are some of the design decisions that we had to take. And there's a possibility we've been looking at taking in other collateral, but that other collateral would have to be then liquidated to the native. So if you take like CUSDC, it would have to be changed to USDC to take part in the protocol, or at least on the outset you get USDC rather than CUSDC, and then you lose, for example, the interest-bearing part of the CUSDC. So all of these are different design decisions, but really the main focus was around aggregated liquidity. So with a very deep liquidity pool on USDC, you can underwrite a huge number of instruments, across multiple markets, rather than fragmenting the liquidity over multiple pools, multiple durations, and all of that. So that was one of the reasons that we went with this approach.
I guess another question that I was going to ask is just like, what do you see as being like the biggest impediment to having, because like everything is perpetual in DeFi, and this is one of the things that like I think keeps people from speculating on rates as much in DeFi, is just the fact that like the ability to manage risk is so minimal with the tooling that's currently available. And I know you guys are trying to fix that by having like structured products and stuff like that. But I guess, do you see DeFi moving towards a place of more fixed duration products rather than perpetual?
I think the perpetual is because people are speculating a short term, so they're not hedging, they're degenning, right? So that's one of the purposes that people are trading perps. I don't know how many. There's very few firms that are actually using perps to hedge.
Well,
Most
not
people
just
are,
perps, but I mean like
yeah,
the actual lending durations too. Because like
yeah,
I'm coming at this from the perspective of somebody trying to build a lending and borrowing protocol, and like when I think about the risk of making these loans that just you can pay them back whenever you want, and I have no say in the level of duration that that people are taking on. And so like I don't know, like sure there's liquidity on AVAX now, but like 3 years from now, is there going to be liquidity? And if there's a big loan outstanding, like, and I have to liquidate this position, that's very difficult to do,
yeah.
maybe.
If
And
we
so
never
like,
if we never get to that point, then it's really useless. I mean, so what are you doing with a DeFi loan? If the only thing that people are doing with DeFi loans is speculate on shitcoins, then we don't really have anything useful, right? Anything that's actually giving to society or actually creating any kind of value. So I would say that if we don't get to the point that we do have durations, then more serious players won't enter. That means also larger capital pools can't enter. And that means that we actually haven't found a fit except for really short-term kind of speculation. Because, let's be honest, if you're taking out these very short-term instruments, what are you doing with them?
right.
I've been,
And I
yeah,
agree
yeah,
with
yeah.
that, and I agree that eventually we need to move towards having fixed durations, because without the ability to have fixed durations, you're not going to be able to um, hedge your risks properly. Like if you can't say I need, I have a 3% interest rate on this loan for this amount of time. I need to hedge against interest rates going this direction. Like that is how real big boy risk management works. And like we just don't have the tooling for that because like you said, there's no demand for it right now, because a lot of it's been speculation. But like I think that a product like yours is building towards something like that, where you're trying to get to a place where the big boys can come in and where the big boys can actually manage risk in a big boy way.
Exactly. I mean, I think you captured it perfectly.
Yeah, I want to ask
Yeah, totally.
Darren, like what time structures have been put in place, like in terms of the fixed interest rates, like from what month, is it 1 month, is it 2 months, is it 3 months, how long?
28 days. So we went to market with a very short-term proof of concept, right? So basically, there's a spot rate, which is the cost of capital at this block height, and a 4-week swap. Why 4-week swap? Because we wanted to start around 1 month and we can't get to 6 months before we get to 5 months, 5 months before we get to 4. So we have a very proof of concept right now, right? So it's actually not really an interest rate swap. It's more like a 4-week forward masquerading as an interest rate swap. But we don't have this semblance of a yield curve. So, the AMM effectively prices a forward rate. So that actually maybe is a little bit of a kind of a product shill. So what's happening right now is we're almost finished with a V2 engine, and that V2 engine is on its last kind of legs of internal development. Then we'll go to testing and simultaneously audit, and that will allow the protocol to start issuing kind of multi-month instruments. The big question there is actually, the AMM will probably have to be tuned to different durations. So, you'll probably have one AMM, that's building for a 1-month instrument, a 2-month instrument, or a 3-month instrument. And then when we have to find basically curve point interpolation, like for example, how do you get the pricing between 30 days and 60 days, right? Like if you want to take a 45-day instrument, the 30-day or the 60-day is not going to be right on. So, you have to have some points in between. But that's so we're already moving towards longer duration instruments. And maybe, when we were first designing this, we saw really cool protocols that we just felt were issuing too long instruments, like like Notion, Pendle, Element. These guys were all offering 6-month and 12-month instruments, which are really great, but they really saw no uptake. And it's my personal opinion that it was just too long. This is why we started with 1 month and starting extending out rather than starting very long term. When everything is very liquid and short term. So, that's some of the methodology behind, why we built like we built.
That's awesome. So I'm thinking, right, like what is the estimate you think before you can see you know these big players basically come in? Like what duration are you looking at to reach? And do you have like any rough, estimate or projections that you think that you're going to reach before you see the big players just naturally come in?
Yeah, well, let's maybe not peg it to the IPOR protocol timeline. Let's look at it more kind of in broad strokes, right? So, I started my career in 2011 in crypto. There was nothing. There wasn't a market. There was nobody. There was about 10,000 people, on a forum, right? On talking on Bitcoin Talk, right? Now, fast forward 10 years later, and I was in Digital Asset Summit in London, and it's all the bankers that for the last decade they were telling us, like I love blockchain, I don't like this Bitcoin, I want to privatize it, right? That for the 10 years they've been saying that. Now they're like, I love crypto assets, right? So that's basically a decade long kind of shift. And maybe for DeFi, let's say 2 to 4 year timeline. I would say maybe shorter if we didn't have the FTX blow up. But I think maybe let's say 2 to 4 years, 3 to 5 years before we start having people toe dip into this. But it will be the crypto native firms that will be first in the DeFi credit market, kind of maturation. There's a huge number of actually former rate traders that are some of the best traders. For example, the guys at QCP out of Singapore. Darius is an ex-rates trader. Melvin, the CEO, was actually structuring the CIBOR, the Singapore interbank offered rate. So you have a lot of very strong people, like Max Boonen is, I think, an ex fixed income trader for Goldman. So you have this really deep fixed income background in crypto. So it'll be these crypto native firms that are the first adopters, and then you have firms like Brevin Howard, that are also kind of DeFi native. You have Nomura, which is some of the biggest rate traders in the world, and they have Laser Digital. So you'll have some kind of larger financial institutions that are now toe dipping that are going to start getting into this. And then maybe you'll see this wave in 2 to 4 years, 3 to 5 years. But you'll have a lot of other players that are kind of stepping in and growing and really trying to get ahead of the larger players. And that's in my opinion.
Okay, so sorry, this probably will be the last question from my end. So I'm thinking, right, for people who might be listening, right, and are just, let's say retail players, right, in the space. What do you think, or what would basically be your advice if they want to play around, you know, providing liquidity and also basically the power tokens, right? What would be your advice, in terms of the first approach they can take with basically getting familiar with the IPOR protocol? And then secondly, do you think that if someone has like a base, or should I say a grounded knowledge in game theory, will they do better, right, at understanding how power tokens work? And because I was reading Darren's thread, and I got fascinated where he said he said something about those who are ready to play and those who basically don't want to play at all are the people who eventually lose. And so do you think, like, having some knowledge in game theory can really give you an advantage?
Well, maybe I will take that one. I don't think that you need to specifically have like knowledge in game theory. Like this is needed to in order to design the mechanisms, but definitely not needed in order to optimize. Like the concept of like the Power IPOR boost. Like okay, so first of all, yes, to start somewhere. Like I said at the beginning, like when we were devising those liquidity pools, basically the idea was that we want to have a protocol that is going to yield the highest stable coin basically yields in the industry. And since we have launched, actually we have achieved that. Yes, like for since we have launched, we basically have like a between 6 and 8% real yield. So this is like stable and stable yield. And then our liquidity mining yields. We started the liquidity mining in 20th of January, I think, or 25th of January, something like this. But basically, for 2 months straight, we are number one, number two, and number three on DeFi Llama in terms of like liquidity mining yield. Now, obviously, the yields are very high, and those are the base yields. So when people see like, okay, oh, it's earning 30% or 34%, this is the base yield. This is if you just come and you just deposit stables into IPOR, and that's how much you get. A very big amount of the users of IPOR that understand how to utilize Power IPOR in order to boost their liquidity, they are not earning 30%. They are earning 100%, 120%, 150%. Why this is the case? Yes, because obviously you cannot have everybody earn 150%. Yeah, so this ties back to the issuance of IPOR and the utility value that each IPOR token has for liquidity providers. So there is a reason why IPOR started with basically an issuance from zero. Yes, we started from ground zero, and then the only tokens that are coming into circulation are basically some vested tokens from investors that they might decide to put on the market or to use themselves, and the tokens that are coming from liquidity mining, the issuance, which is 10,800 tokens per day. Why this is the case is because the entire idea of being able to give boost to somebody based on a proportion of the amount of liquidity that they're providing and the amount of tokens that they hold is how we optimize for decentralization, for broader distribution of the IPOR token, and second, how we basically bridge the gap between, let's say, whales and retail participants. Now, if you are a whale and you come with, let's say, you come and you deposit $1 million, it's going to be extremely difficult for you to acquire the amount of IPOR tokens to get a significant amount of boost on your liquidity. yes, to get like a 3x or 4x or 5x. This will mean that you need to basically purchase a big amount of IPOR tokens from the market, but the market might not have that amount of IPOR tokens outside, yes, because we have not issued that amount of tokens. This is something that is going to be happening through time because tokens enter circulation via liquidity mining. While if you are let's say a smaller participants, you come with like you have like $10,000 or $20,000 that you are depositing as a liquidity, you can basically obtain 2,000 or 3,000 IPOR tokens, and you are going to get like a multiplier on your APR. So in a way, the whale is going to be earning 30%, you are going to be earning 100% on your liquidity. Yeah. Obviously, you are not going to be earning 100% on $1 million. You're going to be earning 100% on whatever your deposit is, $10,000. But this is the game theory. And then if you want to optimize it, yes, if you want to have like the most efficient one, you calculate basically what is the value. Yes, you go there and you sum up. Okay, if I'm depositing, let's say $10,000, I'm getting 30% APR. If I'm depositing $10,000 and 1,000 IPOR, I'm getting 60% APR. So I move from 30% APR to 60% APR. And in order to do that, I need to basically invest $2,000 or $3,000 into IPOR. So now my portfolio value is no longer 10,000, but I basically add the cost of IPOR into my portfolio. Yes. So in a way, your return is no longer 60%, but it's a little bit less. It's let's say 50%. So you just moved from 30% effective APR to 50% effective APR by understanding how Power IPOR works. Yes. So if you want to optimize, this is what you should be looking for. Yes. Like what is the highest effective APR that I can achieve? Basically combining the value of the liquidity that I have provided and the value of the tokens that I have delegated.
Thank you, sir. So much for me trying to keep this one at an hour. I should have known better. Is there anyone who would like to ask a question to Darren or Dimitar? You're very welcome to come up. We passed the hour, so we could quite easily just stay here for the next two. I don't mind. So if anyone would like to ask a question, by all means, just put your hand up. You're very welcome to come up. Doesn't look like it. Clearly, we've covered this topic quite extensively. I've definitely learned a whole lot of stuff today. Thank you, gentlemen, for your time. And most importantly, for your efforts. I think you guys are building something that is obviously very relevant and has a very important place in the context of what is happening in DeFi. So let's see how it plays out. At the end of the day, I think we all acknowledge that, this is an experiment. DeFi is an experiment. It seems to be working so far, despite all the challenges. So let's see how IPOR entrenches itself in the importance of interest rates going forward. And yeah, thank you very much for coming on, and to everyone who did join us. And look forward to chatting again and seeing how things develop in the future.
All right. Thanks for hosting. Thanks for having us.
Thank you,
Cheers.
sir. Cheers.
Pleasure.
Thank you,
It was great, man. Thank you. And thanks, Ben, for taking time off work. You probably were very busy. Appreciate you, sir, for coming up.
Yeah. Thanks for having me on.
Cheers, gents. Take it easy. Have a good one.
Thanks, Darren. Thanks, Dimitar.